Two of the most fondly held cliches in financial commentary are that one should be fearful when the last bears start to turn and to beware of the deadly words, "this time is different." On this basis, investors should be feeling rather twitchy. In recent weeks, as US equities have hit new all-time highs, one of the world's most high-profile perma-bears, the investor Jeremy Grantham of GMO, has declared that we may have entered into a new era of permanently higher stock market valuations, and that we are not in the bubble many have been so eager to call for several years. Mr. Grantham argues that this time really might be different because the higher earnings power of an ever more consolidated number of US companies justifiably means that these mega corporations deserve to trade at higher multiples than in the past. In an age of deeply held cynicism about the role of central banks supporting asset prices and lingering trauma from the crash of 2008, such views are highly unfashionable. However, anyone seeking to instantly dismiss them would do well to remember Mr. Grantham's deceptively simple point. At a time where ever more investors are choosing to view the world through the spectacles of index funds rather than individual company accounts, there is a risk that they begin to view all earnings, balance sheets, and business models as being equal in quality. But they are not. Indeed, the S&P 500 index trades at an optically expensive forward price to earnings multiple of over 20 times. And yes, much of the indice's gains for the year have been driven by large tech companies making fresh highs. Yet companies that have high margins, no debt, and require little capital to compound the growth of their businesses do deserve to trade at higher multiples than inferior stocks. Businesses that require minimal capital to grow frequently use intangible assets such as brands or data to generate their returns. Today, over 80% of the S&P 500's market value is made up by intangible assets, according to Ocean Tomo. Yet accounting rules dating back to the 19th century do not allow for these to be recorded on balance sheets in the same way as physical assets. That companies like Facebook and Google trade at higher multiples than railroad and steamship operators does not mean that they are necessarily overvalued.